well. Then take a little deep dive into our demand outlook for this upcoming winter, and then just further analysis of the winter congestion, zone A, D rate, gas, oil generation, and the summary for you. So I'm going to hand it over to Armand here, who's going to take you at a fall 2014 look back.
Thank you, Stefan. Well, hello, everyone. This is Armand. So let's start with a fall look back. Let's begin with looking at how we did. When we did the fall outlook, you're seeing 5 statements that we have made. We called out for strong IMO imports in October, and we did say we were expecting more than 1,200 megawatts. Actual IMO came at 900 megawatts. That's less than what we forecasted, obviously, but that was due to a D rate of the IMO, which we will get into detail in just a few slides. But there was a D rate on the IMO for quite a long time, and because of that D rate, IMO had to come in below 900 and 700 megawatts during certain times. We called for strong exports to New England, and we did say it would be over 600 megawatts on peak average, just because that's what the statistics showed. The actually did came in at 600 megawatts, so that was in line with our forecast. However, it would have been a lot stronger if there was not a D rate of 600 megawatt flow limit. So that's kind of that was unforeseen by the time we did the full outlook. We were not expecting to see that D rate. So if it didn't happen, those flows would have been a lot stronger. We did also call for strong central east congestion, and that would send upside to east side of the state, F through K. That did happen as expected. And also, unlike IMO and New England, we did see the HQ line work scheduled. So what we called for is increased zone A volatility due to this outage. So yes, zone A was occasionally, it was volatile, but that was also because Niagara Packard 115 kV line outages were in place, which added to that volatility. However, during during this fall, we had back to Niagara line outages, which derated IMO imports, and that imports really kept zone A volatility low. So a couple of things happened in zone A. And finally, we did say a D rate of TGP pipeline is expected to increase gas prices and increase exports to New England, and that happened as expected. Looking at demand here, fall 2014 was warmer than average, which also matched our expectations. September especially was warmer. Actually, September 2nd, we had our peak, summer peak, but we can't really say summer peak because September, it's not one of the summer months, even though it's in the summer capability period. So September 2nd, almost 30 gigawatts was higher than any day in June, July, and August. Whereas in October, it was also much warmer than average, and it was slightly wetter. We got more than 21 gigawatts. That was on October 15th, and that was due to weak cooling load and it was cloudy, so we had a lot of lightning load on that day too. And finally, this past month, November, it was cooler than average, 2 to 4 degrees for most of the state. And November 18th, we had the highest peak load with 22.5 gigs of heating load. One of the very important things to look back during this fall is tie lines. There were 3 major AC D rates between HQ, IMO, and New England AC. They were not for a very short amount of times. They were quite long, and they were very important. They had very direct impacts on prices across the NYISO. You can see the dates here: HQ, IMO, and New England AC. They were for long periods of times, and sometimes they came in and went back out. Either it is an outage or a D rate. So let's start with HQ, HQ imports. You can see the blue line here. It's bottoming out in the middle of October 4th through the 26th, so pretty much the whole month. And you can see the red line being the reference prices increasing during that time. Because HQ is cheap imports, It's a cheap price of electricity, and once we're losing more than 1,000 megawatts, that directly impacts reference price. So prices overall went up during this time, and we didn't see much of a zonal congestion. That's because reference was, as seen in this graph, impacted directly. So overall prices in every zone have to go up, and also towards the end of November, for a few days, actually 15 through the 17, we lost it again, and prices went up again. Ignore the first couple of days of September here in this graph. It's only high because, as I said, it was really hot in September. And IMO D rate, that has a significant value for Zone A, especially. Here, we put two graphs on top of each other, IMO imports and how they trend with Zone A congestion. You can see in the middle where both lines are bottoming out. That's just to show you that once IMO imports are derated anywhere below 900 megawatts, Zone A congestion pretty much diminishes. It's at $0 NTC. You can see here. Again, that was for a long amount of time, this IMO D rate. So that's one of the biggest reasons that Zone A was bearish for the whole fall season. And finally, New England AC D rate. That's a little bit less obvious to see, but we can see here one thing to note. Those numbers on the left, even though they're positive, they're actually the megawatt amounts of exports to New England. You can see here, once they're low, the blue line, the Zone G congestion is 0. But once we start to send more, Zone G congestion goes up. And once again, this New England AC D rate was for a pretty long amount of time, in and out. But overall, that was also one of the biggest reasons that Zone G was low. And for a winter look back, let's see what we can learn from last winter. I'm going to hand this back to Steph.
Thanks, Arman. So yeah, a quick run through of what happened last winter. I'm sure it's still fresh in everybody's mind, but we'll go over it. It'll give us a little context for what we're going to do going forward here. So overall, last winter we did see extremely cooler than average temperatures, the polar vortex. Several 2 to 3 day periods in January and February. We had highs in the teens and lows in the negative 20s and single digits. Very, very cold across pretty much the entire northeast of North America. Really got hit by it multiple times over the winter. So here's a breakout monthly. Heating degree days were actually up slightly from average for December, at least out in New York City in the south. And then moving into winter, as the cold really started to come down from the north, you can see there February 16th or February there were 16% stronger heating degree days than average for Buffalo and for the western part of New York. So we did get a new winter peak, 25.7. That was on the 7th of January. We did not receive record pricing until the gas spiked towards the end of January. That was during another polar vortex event. We can see we had G up in the 460s. One thing I forgot to mention, all prices and values here are day ahead on peak average unless otherwise noted. In this case, we are showing the peak load values, but these are the on-peak average day ahead prices that we are comparing them to. Quick recap of what happened with gas. We can see the strong spikes from the 19th of January through early February. We see, Algonquin, which would be expected. You can look at where it came in last year, and you can see it's quite volatile. But Z2, Z6 followed it up, drove that very, very strong pricing in New York that we did see. TECO M3, typically more of a PJM hub, just displayed here so you could see what the neighboring RTOs were going through at the time. Also, you can see how strange this volatility was, as we usually don't see a lot of action on M3, but here it traded up to $80 at one point. Here is a summary of what happened over the HQ tie. We can see that when there were the extremely cold temperatures in Montreal, we did start exporting out to the north. This is just to represent or to show how difficult it was to get power from neighbors, and that the entire northeast of North America was pretty much frozen last winter, and everybody had very strong pricing. So now we're going to get into the winter demand outlook for this upcoming winter. So overall, we do expect it to be colder and drier than your average winter. Now that being said, we are not expecting the polar vortex weather events to continue. So instead of extreme colds, we'll have more consistent colds than a typical year, but again, it will not be nearly as extreme as what we saw. Also, it will not affect nearly as much area as the polar vortex did last year. Here we have I've broken down monthly once again. So December, we are expecting some pretty typical weather, not a big variation from the average. Into January, especially out there in the west of the state, Buffalo, we will begin to see colder than normal averages. And then by February, it's going to be very cold, 3 to 4 degrees cooler than average across pretty much the entire Northeast. One very important thing to highlight here is that heating degree days will actually likely decrease going into February. So despite February being colder than average, since February is typically warmer than January, the heating degree days will be less. So overall, gas and power demand should actually be less in February than January. Quick look at precipitation. Once again, just below average. It's going to be a very dry, cold winter. Not a lot of implications for power demand here. So quick definition of the heating degree days. The measurement to measure relative heating demand. Basically, you take a 65-degree day and then you minus the average temperature of that day, and that's how many heating degrees. That's the value of that heating degree day. So here we have a past 3-year look at New York and then a forecast for the amount of heating degrees for this year. As we said, December looks to be in line with what we would normally see. Remember last year we actually had a relatively warm week, December. So it looks like 2014 and the winter 2013 to 2014 and the winter, I'm sorry, 2013 and 2014 for December look to be in line with each other and pretty much on average as well. Getting into January, we are expecting above average heating degree days. However, we are expecting it to be below what we did see last year. And then once again, going into February, same story. We are expecting an above average heating degree, but not nearly as much as we're going to see in January, and it will be significantly reduced from what we saw last year. And that pattern is consistent across the majority of the state. So just a quick summary of the methodology and what we're looking for. Once again, colder than average pattern, but we are not expecting any extreme weather. Seasonal December, cooling anomalies under the reach in January, increasing intensity into February, strong heating degrees for January. Cold over the eastern half of the country, driven by some ridging in the eastern Pacific. Keep warm conditions in the west and puts the east below seasonal. Weak El Nino is going to support the overall cold winter condition and less increase once again year over year. So Armand is going to take you through the first half of the 2014-2015 outlook.
Thank you. Yes. Zone A outlook for the winter. We do get a lot of questions and requests just for Zone A and what to expect from it. So we decided it's a good idea to break it down per month and see what we can expect. So let's start with December. As you can see on the slide, we're looking for an uneventful but volatile month for Zone A. Maybe relatively cheap compared to last December's, speaking for Zone A. And that's because temperatures are expected to be slightly above normal or normal, and we do have a healthy supply stack in December for Zone A. We don't have any outages expected or scheduled, and we're calling for a volatile Zone A because we have IMO imports coming back online on December 5th. There will bring Zone A congestion back into the play, because as strong IMO imports come in, if it coincides with strong Niagara hydro units, then that's when we see very strong Zone A congestion. It's also volatile because we have Niagara Packard 115 kV line outages. I checked it today, and it looks like those two lines are expected to be online on December 24th. So pretty much the whole month, these two lines are going to keep Zone A volatile. And once they come back in January, now we're talking less volatile. But we're definitely looking for more heavily congested Zone A and prices comparable to previous winters. So once those two lines are back online, we're going to see less price driving, drivers in Zone A compared to December. If I were to give an example, if PJM imports came in low, they would drive prices a lot more in December compared to January, just because of those Niagara Packard 115 kV lines are going to be online. Bearish line outages, we don't see any major line outages in January, except we do expect this inter-east congestion because there are a couple line outages I'll show you in the next slide. Is going to derate this interface, so that will have a bearish impact in Zone A in January. As for February, unfortunately, outages are not really visible for us yet. It's it's really far out. But we are expecting strong winter loads, so strong congestion across the whole state. But what we can see is 600 megawatts of Moses South derate scattered in February. What that will do is that will decrease HQ imports or Zone D generation. So generation has to decrease up north because with that 600 megawatt Moses South derate, the interface now can only carry 2,000 megawatts, as opposed to if HQ came in at strong, that would not be an option in February. So let's talk about Central East congestion. That always happens in the winter because we always see strong exports to New England. That always comes with strong gas prices and strong demand, and that's how we get the Central East congestion. It makes the market more volatile to transmission outages and generation availability, because once the Central East congestion is binding, all the generation that's on the east of that interface has more responsibility now. So if there are any generation outages, that will definitely significantly impact prices. And also, while it is binding, we're going to see less imports from Ontario, because those imports come and fall on the left side of this interface. So they're not going to be able to carry all these flows to the state while Central East is binding. Another driver of Central East congestion is fuel prices, because once fuel is more expensive, New England really needs those imports from NYISO. So once we send those strong exports, that's definitely one of the biggest drivers of Central East congestion. Okay, now we're showing you transfer limitations here. By no means this is the entire list. Those are handpicked. So the most important things to note here are the two bottom ones, Niagara to Rochester and Niagara to Kintyre. As you can see towards the right of the graph or table, the impact, the megawatt derate on that interface. So it is 1150 megawatts is derate from the original limit. So this interface is going to be able to carry over only 1700 megawatts. So it's already more than that, and given winter demand is going to be really high, Zone A is going to receive downside from that. So that's why we call for bearish Zone A during those times. Also, up top, Athens to Pleasant Valley, that's dangerous because it can create Pleasant Valley to Leeds congestion. That's upside to G and K and downside to F. So during those times, we are looking for a little bit wider FG spreads. We're not seeing many generation outages. We're expecting generation outages to be limited through the winter months. As we spoke about it already, NYISO gets ready for the winter time, both generation-wise and the transmission line-wise. Everything needs to be healthy and ready in case something goes wrong. So we already talked about Niagara Packard coming back at the end of December, and Zone A congestion risk is going to come back with it. I mean, the volatility is going to decrease once those lines are back online. But long-term Pleasant Valley outage is going to increase the risk of Pleasant Valley leads congestion. As you can see, there are all these line outages and CB switches just around that area. So that's why we're calling for increased risk. This graph shows you what historically the last two winters, just looking at what the deviation from the TTC is for HQ imports as opposed to how the temperature was. So basically what this graph is showing you that if you look at all the way to the right, once the temperatures are above 50 degrees, the deviation from the TTC is really very minimum, meaning that there is not that much derates on the HQ-AC. However, as the weather gets colder, we start to get really low imports from HQ. So that's something definitely to be aware of. Looking at the weather forecast, if it is sub minus 10 degrees, we should definitely decrease HQ AC in our forecast, and that's definitely statistically as shown here. Looking at IMO flows, IMO flows have been increasing year over year, but last year could have been a little bit stronger. There was a spike in the Union Dawn to Henry Hub basis, which drove exports in late February. You can see in the left graph, as the basis increased to above $5, we saw quite a bit of decrease in HQ imports. It looks like around 500 megawatts decrease in the imports. And once we had that spike towards the end of February, that's when we actually exported to Ontario over the IMO. And you can see on the right graph the last 4 years of IMO, and it's always increasing, and that trend is expected to continue. Probably not as you can, probably not going to increase so much more, but we're looking for strong IMO imports. And finally, PJM and New England ACs. You can see the trends here, the last 4 years of both ACs. PJM, last year PJM was a little bit of a one-off. They had 2 of their nuclears out, so they weren't able to really export as much. But it's hard to guess, but definitely the trend may continue, so we are calling for slightly less imports from PJM. And as for New England, you can also see here the last year, the 2014, we had the highest exports to New England, and that's because it was extremely cold and gas price was extremely expensive, so we had to export a lot to them. This year, we're also looking for strong exports, but probably not as much, or probably not stronger than last year's. So I will hand it over to Stefan again.
All right, saving the best for last here. Looking at gas pricing going into the winter. So here we're going to see the M3, Z2, Z6, Algonquin, and TGP. Obviously, the winter of 14 with the strongest pricing there. So what we are expecting going into this next winter is we're still going to look for strong gas prices. As I've said multiple times before, we're going to have a fairly substantial amount of heating degree days. The key difference here is we will not see the extreme cold, the polar vortex that we did see last year, and we're not going to have the issues with just a complete lack of supply across the entire North America. So we're not going to see nearly as strong as prices as we did see last year. Now, it's important to understand, residential and commercial demand for gas will continue to grow pretty much across the United States, certainly in the Northeast as well. So that will continue to eat up some of the available supply, start to push up the price for generation. And again, it is going to be very cold. We do expect people to trade it up. However, we are not forecasting the same sort of price levels that we did see last year, but do expect it to come in above where we saw the 2012-2013 winter. Getting into LNG, so New England is now similar to the oil reliability program. They are now offering an LNG participation program where they will buy back unused LNG to incentivize more purchases of LNG in preparation for the winter. We can see there's already been a request of 1.52 BCF. Furthermore, just a little background here, there's the LNG terminal at Everett, which pumps directly into Algonquin, which will decrease the pull on New York with the exports out to New England. It also pumps directly into TGP, which will have direct downside to quite a bit of generators out there in the east of the state for New York. And all signs show that they have been purchasing increased LNG and they are preparing for the winter. So we do expect greater insertions of the gas coming in the east of the state there at Everett, adding further downside to the year-over-year gas prices. Getting into the gas-oil switching. Now, over 60% of the gas-fired generation in New York is listed as having the ability to switch to oil. We know that they do this when the gas price reaches a certain level. We expect them to go over to oil, make it slightly more economic. Also, if a unit is having trouble getting gas because of certain constraints on a pipeline. So as I said, 60% of the gas-fired generation does have the ability to switch, but we have here some values from EIA that we did collect for last year. The last 4 categories there are January, February, March, April, and it's the total oil consumed by various generators. So you can see that, you know, have the ability, but only a handful do switch over to oil. Here we can see Roaston, Astoria, and the North Ports are the primary users of oil. This makes sense. What we're not seeing on here are the Athens, the Bethlehems, the Empires up there in Zone F. Reason being, or one of the factors there, is that all of the generators here are very, very close to the New York harbor, where they can directly barge in this gasoline. It's also a major trading point. So they're not paying as much a premium for transport. They're not paying as high a basis, if you will, for the other generators in the state. So we definitely look for this trend to continue. As we can see, there was a large quantity of oil consumed in January, falling off a little bit in February, falling down more into March, and then barely anybody consuming oil going into April as gas prices settled and temperatures began to rise. Looking at this next comparison, what we did was calculate the total MMBTU from all the oil, and then compare that. A lot of these generators were also consuming natural gas. We did it just for January, as we did see that was the highest consumption. And in a MMBTU to MMBTU comparison, we saw that the majority of units that do get on oil just for one time last month consumed more than 50% of their total production was done on oil. So that tells me and tells us that once they do make the switch to oil, they run for quite some time. They're not just getting on during the high gas days and then coming back down. More than half of the month, in Roaston's case and Astoria's case, pretty much the entire month, their entire production was done solely on oil. A lot of these generators do have multiple units, so they may just commit one unit to oil. But once again, we will be looking at this going forward, and we monitor quite a few of these plants. So once we see the one that we suspect to switch to oil, we will look for them to stay in for, you know, about a week, at least 5 days. Speaking a little more to oil, all-time oil currently trading 35 cents per gallon below the 5-year average. There is a surplus of oil. If you look at the product storage, pretty much across the board, whether it be jet, diesel, gasoline, or ethanol, the storage levels are higher going into this winter than we did see last winter. So we will see that switch to oil occur at lower thresholds than we did see the previous year. So we will be watching that going forward as well. All right, and again, last but not least, we are expecting Dam Scammer to return. So a little background, Dam Scammer Generation Station was mothballed after sustaining significant damage during Hurricane Sandy. Basically, it's right there on the river, and the basement flooded. It was rebought and is now going to be refired on pure natural gas. It was previously a coal oil unit. So it's going to be 530 megawatts of total generation. They're going to have 2 units that are committed just to burning natural gas, and the other 2 units have the ability to switch to gas, to oil, or to coal. So again, look for maybe them to begin purchasing some oil as well, help alleviate some of that winter gas demand. So the effects of them coming back in, they are right there in Zone G, so we are looking for a downside to that Zone G and those eastern prices as they do begin to run. We are going to look for reduced Central East and reduced Pleasant Valley leads congestion, weaker shadow prices as they will be offered to be able to put in about 500 megawatts, 530 megawatts directly on the upside of both of those constraints. So significant alleviation there. As of right now, they are expected to be back by the end of this year. Now, we do monitor Genscape. You can see the image down there. We've seen some bumps coming from them, but nothing to indicate the level that unit is ready to go. Also, not 100% sure on when they will begin committing that unit into the day ahead. We will keep our clients updated. We will continue to monitor the progress out there, and we will let you know when we see anything out of Genscape. So in summary, below average temperatures, above average amount of heating degree days, but once again, really need to emphasize we are expecting a much less harsh winter, less heating degree days than we did see last year. Imports still expect to pull back on those HQ imports when those temps in Montreal get close to zero. Expect exports if it starts to get sustained below zero temperatures, that is in Fahrenheit out there. And then also looking for some more imports coming in from IMO, assuming there is not another spike in the Dawn Henry Hub gas basis. And expect the general trend of strong exports to, or decreased imports from PJM, strong exports out to New England. However, last year, most likely an outlier. Expect things to stay relatively similar kind of year over year, and the downside trend should begin to even out there. Fuel inputs, so we're going to look for them going over to oil a little sooner, as we do have significantly weaker oil prices. Also, the increased LNG into Everett should help to bring down the Northeast basis a little bit. Transmission, mostly downside Zone A transmission risk, some increased Pleasant Valley leads, congestion risk with a few outages there. Generation, once again, the return of Genscape into Zone G. And that is going to do it. One last thing, we did recently release a power buyer product for NYISO. So it does come with real-time price forecasting for all 4 zones. We do offer DART spreads, risk scenarios, demand forecasts, and then a risk-adjusted strategy, day-ahead versus real-time. It's great for power retailers, also great for virtual players. If you're interested in a trial, please let me know. And that's going to do it for us. So we'll wait a few minutes to see if anybody has any questions. Yeah, I'll be back in a few. If you have any questions, go ahead, put them in the box. Also, please, we know we disconnected for a little bit there. That was our mistake. I'm sorry about that. If you missed anything, if there were any slides that you didn't hear what we were saying, please let me know, and I'm happy to return to those. Thanks. So we got some questions about the amount of oil running in January, what the driver of that was.
to answer the question, yes, the drastic increase or the large amount of generation on oil was, of course, related to the high price of natural gas. However, natural gas was well over its limit of where we would typically see oil generation step in. So again, I am assuming that those generators will be back on oil for some choice days in January, even if those prices don't break into the high 80s that we did see for a few days in January. I'll give it one more second for any more questions, and I'll let you go. All right, looks like that's going to do it for us here. Thanks for joining me. You will receive the slides and the recording shortly, and please let me know if you have any questions. Thanks. Bye.